Hey everyone, and welcome to The Explainer. Today, we are putting a massive, highly complex global asset manager through the absolute ultimate analytical test. We're taking a hard look at Brookfield Corporation, and we're going to run its latest Q1 2026 financials through what I like to call the Guru Gauntlet. Basically, we're going to strip away all the market noise and evaluate this absolute behemoth using the proven frameworks of some of the greatest investors in history, plus a few modern valuation models, just to see what the numbers actually tell us. Here is a quick roadmap for this explainer. We'll do a Brookfield snapshot, look through the Warren Buffett lens, the Peter Lynch lens, the Benjamin Graham lens, dive into DCF and valuation models, and wrap it up with our synthesis and final verdict. Let's get to it. Section 1. Brookfield Corporation Snapshot, the $96 billion behemoth. All right, just to set our baseline here, Brookfield Corporation is currently trading at a share price of $43.73. That gives the company a staggering market capitalization, which is the total value of the company, of just over $96.2 billion. I mean, they are a literal titan in the financial world. But what exactly makes up that $96 billion? Well, Brookfield basically focuses on building long-term wealth through three core pillars. First, asset management, which boasts an unbelievable $614 billion in fee-bearing capital. That's money they manage for other people that generates sweet recurring revenue. Second is Wealth Solutions, holding $180 billion in insurance assets after the recent buyout of Just Group. And third, their operating businesses, which own real hard assets like real estate, renewable energy, and infrastructure. But there is a massive catalyst on the horizon. Management is pushing a plan to combine Brookfield Corporation with its Wealth Solutions arm, B&T. This move is literally designed to unlock $145 billion in excess capital, giving their insurance business a competitive advantage that's honestly hard to overstate. Section 2. The Warren Buffett lens, moats, and owner earnings. Now that we know what they do, let's put on our first pair of glasses, the Warren Buffett lens. Buffett loves businesses with wide economic moats, predictable earnings, and manageable debt. So when we weigh their strengths against their risks, Brookfield's economic moat is just ridiculously deep. It's built on global scale, over $1 trillion in total assets under management, and this thing they call the Brookfield ecosystem, where every part of the business feeds off the others. On the flip side, the risks, well, it's incredibly complex, and there's $14.2 billion in corporate debt. But, and this is absolutely crucial to understand, their underlying investments are financed on a non-recourse basis. That means if a specific property goes belly up, the bank can only take that specific property. In fact, only 5% of their total leverage can actually come back to bite the parent corporation. Okay, let's talk about Buffett's favorite metric, owner earnings. Because Brookfield owns a ton of physical real estate and infrastructure, they take massive depreciation charges. So traditional net income, it's pretty useless here. Instead, we have to use their distributable earnings, or DE, as a proxy for owner earnings. Over the last 12 months, that was a massive $6.009 billion, or $2.54 a share. Now, you might notice their official return on equity looks shockingly low at 2.64%. But again, that's kind of just an accounting illusion. All that non-cash depreciation suppresses standard net income, making their ROE look super weak compared to the mountains of actual cash they are generating. Section 3. The Peter Lynch lens, categorizing the giant. Moving right along, let's view Brookfield through the eyes of Peter Lynch. Lynch loved categorizing companies to figure out how to value them, and he leaned heavily on PEG ratios and insider activity. Under his framework, Brookfield is the ultimate asset play. I mean, they're sitting on $188 billion in deployable capital alone, plus all those hard assets the public markets might not fully appreciate right now. But if we run a strict Lynch quantitative screen, we hit a bit of a yellow flag. Brookfield has a trailing PE ratio of over 82. You compare that to a 6% growth rate in distributable earnings per share over the last year, and you get a really high PEG ratio. Normally, for Lynch, that screams overvalued. But wait, here's the kicker. Insider activity was one of Lynch's absolute favorite signals, and Brookfield's management has been buying up their own stock like crazy. In just the first quarter of 2026, they did over $1 billion in total share buybacks. They grabbed $470 million worth of BN Class A shares at an average price of around $41. Why? Because management explicitly stated they believe the true intrinsic value is $66 per share. They basically think they're buying a dollar for 60 cents, capturing a huge 40% discount on their own stock. Section 4. The Benjamin Graham lens, the defensive checklist. Now, let's put on our strictest pair of glasses. Benjamin Graham, the father of conservative value investing. Graham loved his defensive checklists, and honestly, Brookfield breezes through almost all of them. Adequate size. Yep, 96.2 billion. Strong finances. You bet. A current ratio of 1.14 means they're liquid. Stable earnings? Yes, thanks to all that recurring fee revenue. Dividend record? Sure, a steady, if slightly low, 0.59% yield. But here's the real standout. A moderate price-to-book ratio? Oh yeah, they trade at a deeply discounted price-to-book of just 0.58. But, and this is a massive but, Graham's actual intrinsic value formula is absolutely ruthless. The formula multiplies 22.5 by earnings per share and book value per share, and then you take the square root. Now, because of all that heavy depreciation we discussed, their official diluted EPS is a measly 50 cents. So even with a strong book value of $75.39, Graham's formula spits out an intrinsic value of just $29.12. So at the current price of around 43 bucks, there is zero margin of safety for a Graham purist. By his textbook math, it's way too expensive. Section 5, DCF and Valuation Models, Modeling the Future. Okay, so since reported net income kind of breaks down for an asset manager like this, let's step into the modern era with discounted cash flow and sum of the parts models. When we look at cash flows, the whole picture totally changes. Brookfield uses a blended value of capital approach, which is basically a sum of the parts valuation, pulling apart the pieces of the company, and that generates an implied fair value of about $70 a share. If we run our own base case DCF, assuming 6% growth, a 7.5% weighted average cost of capital to match current interest rates, and a 3% terminal growth rate, we land at $48.50 a share. And their current enterprise value to EBITDA multiple? It's sitting at 14.6x, right in line with their historical averages. You know, you might be wondering why we even rely on these cash flow models. Well, management actually hit the nail on the head in their 2026 outlook. The wild era of private equity financial engineering is officially over. You can't just borrow cheap money and wait for multiples to expand anymore. Value creation today is all about operational discipline at real tangible assets. If you own a logistics center, you actually have to run it efficiently to expand your margins. And that discipline is exactly what drives the real cash flows these models are capturing. Finally, Section 6, Synthesis and Final Verdict. So let's pull the whole shebang together. The takeaway here is that your verdict on Brookfield depends entirely on which pair of glasses you're wearing. The super conservative Graham lens hates the low reported net income and screams sell with a $29 fair value. But our base case DCF suggests a fair value of $48.50, signaling a hold or maybe a slight buy at current prices. Then you have Peter Lynch looking at the underlying assets and those massive insider buybacks, flashing a clear buy. And if you trust management's own sum of the parts math, it's deeply undervalued, making it a strong buy. So I'm going to leave you with this final provocative thought. When you are looking at a hyper-complex asset manager that has massive depreciation but generates absolute mountains of cash, do you trust the safe, conservative, textbook Graham math? Or do you trust management's aggressive, real-world strategy backed by a literal $1 billion bet on their own company? That is the real gauntlet you have to run here. Thanks for joining me on this explainer, and keep questioning the numbers.